So hello friends, this is CACS Sai Akash. Let us continue with our revision series. So already I have uploaded basics of FM. So if you can just go through the playlist in our YouTube channel, the first video is already uploaded. Today we'll discuss one more short yet important and scoring chapter, that is leverages. So what do you mean by leverage? Leverage is an instrument to measure risk. So what do you mean by risk? So if I have to divide business risk, I can classify business risk into two types. One is operating risk, another one is financial risk. So what is the reason for operating risk? So operating risk arises on account of fixed operating expenses. So whenever there is fixed expense, it denotes risk. And whenever there is risk, we have leverage. So we need to calculate that risk. So operating risk arises on account of fixed operating expenses. Example, rent, salary, or any other expense which is fixed in nature. To measure operating risk, we have operating leverage. Coming to financial risk. So financial risk arises on account of fixed financial cost. So fixed financial cost, if you see, there are only two. One is interest expense, second one is preference dividend. To be more specific, grossed up preference dividend. So to measure financial risk, we have financial leverage. And to measure the overall business risk, we have combined leverage. So leverages are of three types: operating risk, financial risk, and combined risk. Correct? So to measure these three kind of risks, we have three kind of leverages: operating leverage, financial leverage, and combined leverage. Coming to the next concept. So how do you calculate leverage? To calculate leverage, then first you need to understand the profitability statement. Again, just to quickly revise, sales minus variable cost will give you contribution, contribution minus fixed cost EBIT, minus interest EBT, minus tax PAT. In that you will pay first preference dividend. What will be left out with earnings available to equity shareholders, that if you divide by number of equity shares, you will get EPS. So if you need to know profitability statement first, and only from this you can derive the formulas of leverages easily. Now if you see in this entire profitability statement, where is risk? So if you closely observe, wherever there is fixed commitment, fixed financial cost, there is risk. So in this entire profitability statement, there is fixed cost at two places. One is, if you see the highlighted thing, fixed cost, here it is my risk, and another one is interest. So in these two places, risk is sitting, correct? So how do I measure that? So I'll just hide that line item. For example, degree of operating leverage. Operating risk arises because of operating fixed cost. And in my statement, this is my operating fixed cost. For a moment, if I remove this operating fixed cost, what is left? Contribution divided by EBT. That is my formula. Simple. How do you remember? Wherever there is a risk, hide that line item. So above that line item is contribution, below that is my EBIT. So what is the formula for operating leverage? Contribution divided by EBIT. Same goes for financial leverage. So what is there? Interest is my fixed financial cost. I'll just hide it. So what is left? EBIT divided by EBT. So what is the formula for financial leverage? EBIT divided by EBT. Correct? And combined leverage. Combined leverage measures the total business risk. Total risk arises on account of fixed total cost. It may be financial cost as well as operating cost. Now if you see, what does degree of operating leverage exactly measure? It measures the impact of change in sales on EBIT. In other words, if my sales changes by 1%, what is the impact on my EBIT? If you can see the blue color arrow. Now coming to financial leverage. What does financial leverage measure? It measures the impact of change in EBIT on EPS. So if I change my EBIT by 1%, by what percentage my EPS will change? Now if you see the bigger arrow mark, degree of combined leverage, it measures the impact of change in sales directly on EPS. It means 1% change in sales will lead to how much percent change in EPS. So this is what leverages measure. So leverages are measuring risk, specifically operating risk, financial risk, and combined risk, and they measure the impact of change in one variable on another variable. Okay, let us discuss operating leverage in detail. So as discussed, what does operating leverage measure? It measures operating risk that arises because of fixed operating cost. So what is the formula? The first formula is contribution divided by EBIT. So degree of operating leverage equal to contribution divided by EBIT. The alternate formula, the second formula, degree of operating leverage equal to percentage change in EBIT divided by percentage change in sales. Sir, we remember percentage change in, but we don't know what is dash by dash. You need to remember what is a dependent variable, what is an independent variable. Sales is dependent on EBIT or EBIT is dependent on sales. If you see here, my sales is dependent on my EBIT or my EBIT is dependent on sales. Very obvious, my EBIT is dependent on sales. So whatever is the dependent variable, it will come at the top because it is dependent on something. My EBIT is dependent on sales. My sales is independent. It does not need any support. So with this logic, you can remember the formula EBIT divided by sales. So percentage change in EBIT divided by percentage change in sales. Again, one more formula wherein you can calculate operating leverage, degree of combined leverage divided by degree of financial leverage. One more alternate formula, very important, degree of operating leverage is nothing but it is the reciprocal of MOS ratio. Now you ask me what do you mean by MOS ratio? MOS means margin of safety ratio. It should be read with costing, marginal costing chapter. So what do you mean by MOS ratio? MOS ratio is nothing but MOS sales divided by total sales. So how do you calculate MOS ratio? MOS sales divided by total sales. Now you ask me, sir, how do you calculate MOS sales? So MOS sales is nothing but total sales minus BEP sales. Now you know how to calculate BEP sales. It is fixed cost divided by PV ratio. So what do you mean by PV ratio? PV ratio is nothing but contribution divided by sales. It is alternative. It is complementary to which other ratio? Variable cost ratio. To sum up, again, what do you mean by degree of operating leverage? One more formula to calculate degree of operating leverage. It is a reciprocal of MOS ratio. How do you calculate MOS ratio? MOS ratio is nothing but MOS sales divided by total sales. How do you calculate MOS sales? MOS sales is nothing but total sales minus BP sales. How do you calculate BP sales? Sir, fixed cost divided by PV ratio. How do you calculate PV ratio? It is contribution divided by sales, or it is complementary to variable cost ratio. Again, what is operating leverage measure? Operating leverage measures the impact of change in sales on EBIT. It means 1% change in sales will lead to how much percent change in EBIT. So this is all about operating leverage. All the formulas are covered. Coming to financial leverage, very, very important. So how do you calculate financial leverage? Financial leverage measures financial risk. Financial risk arises because of two things. One is interest, one is gross share preference dividend. So first set of formulas where your capital structure does not have preference share capital as a source of capital. In that case, DFL formula EBIT divided by EBT. The first formula EBIT divided by EBT. Again, from where it is derived, if you come back to the profitability statement, whatever is your fixed financial component, interest is your fixed financial component, just hide that. Whatever is above that is EBIT, whatever is below that is EBT. So formula EBIT divided by EBT. Very simple to derive the formula if you know the profitability statement. No need to mug up any formulas. The second formula, percentage change in EPS divided by percentage change in EBIT. Again, what does financial leverage measure? It measures the impact of change in EBIT on EPS. So 1% change in EBIT will lead to how much percent change in EPS? Sir, how to remember numerator, denominator? Simple. What is dependent on what? My EPS is dependent on EBIT or my EBIT is dependent on EPS? Answer is simple. My EPS is dependent on EBIT. So when something is dependent, it needs something. So EPS is dependent on EBIT. EPS will always come first because it is dependent. It needs some support. EBIT is independent. So DFL formula, percentage change in EPS divided by percentage change in EBIT. Coming to the third formula, degree of combined leverage divided by degree of operating leverage. This is another formula wherein you can calculate degree of financial leverage. Suppose all these three formulas are applicable when there is no preference share capital in your capital structure. In other words, there is no preference dividend as a fixed financial commitment. Sir, what if my capital structure has preference share capital? In that case, the formula would be degree of financial leverage equal to EBIT divided by EBIT minus interest. So if you see EBIT divided by EBIT minus interest is nothing but EBT. So till here, the formula is same. You need to subtract one more fixed financial commitment, that is nothing but preference dividend. But as you know, if you see again, I'll come back to the profitability statement. If you see, my preference dividend is a post-tax item. My preference dividend is a post-tax item. After paying tax, I will pay preference dividend, correct? So if you see, it is a post-tax item. I need to bring it to pre-tax. You know the reason very well because it should be apple to apple comparison. So I need to gross up. So how do you gross up, sir? How do you calculate grossed up preference dividend? Simple. Preference dividend divided by 1 minus tax rate. If you want to bring something from post-tax to pre-tax, you need to divide it by 1 minus tax rate. If you want to bring something from pre-tax to post-tax, you need to multiply into 1 minus tax rate. In other words, if 30% is the tax rate, whatever will come to my pocket is only 70%. So if I have to gross up, then I need to divide it by 70%. So that is the logic. Very simple. So what is the formula for financial leverage? If there is preference dividend also given in the question or preference share capital is also part of your capital structure, it is degree of financial leverage equal to EBIT divided by EBIT minus interest minus gross up preference dividend. Sir, how do you gross up? Preference dividend divided by 1 minus tax rate. So again, what does financial leverage measure? It measures the impact of change in EBIT on EPS. It measures the impact of change in EBIT on EPS. It means 1% change in EBIT will lead to how much percent change in EPS. Coming to combined leverage. So combined leverage, it measures the total business risk, that is total operating risk as well as financial risk. Coming to combined leverage formula, contribution divided by EBT. What is the formula? Contribution divided by EBT. Alternate formula, degree of combined leverage equal to degree of operating leverage into degree of financial leverage. Be very careful, it is multiplied, it is not plus. It is one of the MCQ questions given in the module also. So degree of combined leverage is what? Degree of operating leverage into degree of financial leverage. Coming to third formula, degree of combined leverage equal to percentage change in EPS divided by percentage change in sales. Again, how to remember the formula? What is dependent and what is independent? EPS is dependent on sales, so EPS will come at the top, and sales, which is independent, will come at the bottom. So percentage change in EPS divided by percentage change in sales. Again, what does combined leverage measures? It measures the impact of change in sales on EPS. If I change my sales by 1%, what would be the change in EPS? So that is measured in leverage, combined leverage. Coming to some theory part in leverage chapter. So higher leverage always denotes higher risk. So leverage is an instrument to measure risk. Higher leverage means always higher risk. Again, leverage is expressed in times. If leverage is 2, it is called 2 times, 3 times, 4 times. Again, what do you mean by favorable financial leverage? Again, a very important short note question, a theory question for 2 or 4 marks. What do you mean by a favorable financial leverage? When ROI is nothing but return on investment, is greater than KD. KD is nothing but your cost of capital. This is called a favorable financial leverage. So normally leverage denotes risk. Higher leverage means higher risk. But when risk can be favorable when your return on investment is more than your cost of debt. In other words, I will borrow debt at a lower cost. I will invest in my business and I'm generating higher returns. In that case, whatever is the excess profit that I earn, it will be benefited to the equity shareholders, because as we know, when I raise debt, it comes with a fixed financial commitment, irrespective of the company earning 8%, 10%, 20%, 30%, or maybe losses also. If I'm raising debt, say for 6%, in that case, irrespective of my profit or loss, I have to pay my debt provider only 6%. So the additional profit that I earn, it's directly benefiting my equity shareholders, correct? So if I raise money in the form of debt for 6% and assume I earn, my return on investment is 20%. So whatever is my excess profit, the 14% extra that I've earned, that will be my profit. So this position is called favorable financial leverage. When ROI is greater than KD, it is called favorable financial leverage. This concept is also called as financial leverage as a double-edged sword. What do you mean by double-edged sword? Financial leverage has some advantage also, it has some disadvantage also. What is the disadvantage? Higher financial leverage means higher risk. Higher risk means higher returns. But how can leverage also be favorable? When I'm able to generate more returns than my fixed commitment. So I've got the funds for 6%. If I'm able to generate more than 6% return, in that case, I should be okay in raising money through the form of debt. This is called favorable financial leverage. Again, some concepts for MCQ questions. If there is no fixed cost at all, then leverage is always 1. If there is no fixed cost, leverage is always 1. If there is no fixed cost, leverage is always 1. If my sales is at BEP, leverage is undefined. At BEP, leverage is undefined. If my sales is above BEP sales, leverage will always be positive. If my sales is below BEP sales, leverage is negative. Yes, leverage can be negative. This is applicable for all 3 leverages: operating leverage, financial leverage, and combined leverage. Again, one more important aspect, leverage can never be between 0 to 1. It can either be 1, it can be negative, it can be positive, or it will be undefined. Leverage can never be between 0 to 1. So these are all the concepts which are important from leverage chapter. Again, a formula oriented chapter, very important and very scoring. I request you to please solve the questions from your question bank immediately after watching this video, so that you will be able to do the practical problems also. If you like this video, please share with your CA inter friends. It may help them to clear their CA exams. And keep the channel subscribed, because I will be coming up with the revision videos of other chapters very soon. Thank you and all the best for your exams.